Awesome. We'll just give folks a couple more minutes and then.
Awesome. I'm excited for this conversation. Always happy to chat about equity.
Yeah. I feel like we're relatively rare that for us, like, we're huge geeks about equity, and most other people are like, what is the bare minimum I need to know to not screw this up?
I think that's actually the right question that most people ask, which is how do I not screw it up? And we want to make that easier so that people don't screw it up.
Yeah.
So is this the inaugural AbstractOps Fireside Chat? Is that it?
It is indeed, Miguel.
Amazing, man. It was historical. How are you, man?
Good, doing good. Lots of exciting stuff on the horizon. You should start to see some bits of product and stuff like that soon too.
I love the app, by the way. Like I needed our EIN. I was like app.abstractops.com. That's it. So
awesome.
Yeah, man. Love it.
Get those DAUs up there. Just kidding.
Yes, sir.
Well, cool. I mean, I think we probably get started. Thanks again for taking the time to chat, Yin. I'm pulling up the list of questions that we chatted about, but obviously, like, we'll kind of like have this be a conversation as much as possible, and I'll try to resist my urge to opine on those things and instead defer to your expertise on this matter. But obviously, like, would love to. I think the most powerful thing here is, of course, that we're both very, very passionate about this space. So I'm really excited that we got the chance to chat. So yeah, I mean, to start off, would be great to get just an introduction for everyone else on the call, and obviously any some of the folks who've asked for us to send them the recording after the fact. Just your background, why you're working on Pulley would be a great place to start.
Yeah, absolutely. So I'm Yin. I'm founder at Pulley. And my background is started a few companies in the past, and starting Pulley because I've always felt like it should be easier for anyone to start a company. Our mission at Pulley is how do we allow anyone to start a company? Because I think a world where everyone is only working at a large tech company is not one where you actually get diversity of ideas. And we started Pulley about a year ago, and since then we've grown to over 1,500 companies on our platform. And what Pulley does is we make it easier for companies to manage their cap table and their equity. The insight I think we had jumping in is that equity management, I think for a lot of our competitors on the space, is very much taken from the perspective of how do you manage a number on a spreadsheet. And with Pulley, we think equity is actually all about people. It's how you attract and retain really good talent. When you're raising funding, it's how do you find a good partner and a good investor that you want to work with. When you think about equity from like a people perspective and also kind of a meaningful part of someone's net worth, there's a host of other features that we felt like we're missing in the market today, and that's what we're looking to tackle with Pulley.
That's a great segue and place to dig in. So how is that like philosophical difference baked into the product? What are some things that you've prioritized that other people didn't because you believe strongly in that?
Yeah, it's interesting because like the questions, I would say it ultimately comes back down to the user, right? So like for us, it's the case that when we talk to users, they're not asking, how do I record an incentive stock option grant on my cap table? How do I record federal exemptions? Or they don't even know what that means. Like we were just chatting, like I think right before a lot of folks joined, is like people just don't want to make a mistake. The questions that founders and employees actually ask is like, great, if I'm the founder of a company, how much equity do I give my first engineer? If this company does really well from an employee perspective, like what does this even mean for my options? For founders, it's like, great, I'm going to raise another round of funding. How much solution am I actually going to take? What we've seen is, especially when we talk to companies at the seed stage, when there's pre-money stage, post-money stage, so there's convertible notes, there's pro ratas, even asking the basic question, and I think everyone on this call should ask themselves this question, which is, how much of the company do you actually own, ended up being something a lot of people can't answer. So equity is that unit that actually grows if your company is really successful. But if you don't even know how much of it owns, then it's really hard to plan for the future of your business. So when we take it from the perspective of like, let's go back to first principles, think about what the user is needing. They're not thinking about this as a number on the spreadsheet. What that means is Pulley builds out amazing tools like how do you issue an offer letter to an employee and explain how options work? How do we build out a really great modeling tool so that you can understand how much solution you're going to take? We very much are building for founders and employees, people that actually are holding the equity.
Got it. So I have one comment and then a follow-up question.
Yeah.
The comment I was going to say is, so to your point on like the ownership percentage, yeah, I mean, every time we provide an offer, or even like when we think about it internally, we have the FDSO, and then it's like an adjusted FDSO. So for those who don't know, it's fully diluted shares outstanding, which is essentially not just the shares that have already been issued, but the shares that are in your option pool, and so on and so forth. So things that are issued or issuable have been reserved. But I was going to say, we actually have an adjusted FDSO, which is like upon conversion of the safes, right? Because I think the problem that ends up happening is, especially for early stage companies, and the longer companies wait to actually convert those safes, right? They're giving out 1%, but like they've already diluted themselves 50%, right? And the employee has no idea that's the case. And so I think there's kind of this, to your point, this like need for transparency to understand, well, what does that actually mean for me as a recipient and for me as an owner?
I think that's spot on. So like you're actually even diving into a level of detail that we see few companies actually providing. So like a lot of times, oftentimes when you get an offer letter, all you get is you get X number of shares. But what's the denominator? You could get one share and the denominator is 2. And then it's like, great, you own 50% of the company. It's meaningless. Or yeah, go ahead.
No, I was just going to say, I mean, and the funny part is, I mean, we're talking about early employees here. I've actually talked to executives at like Series C, Series D companies who literally would say something along the lines of, yeah, I went with this company because they gave me 10,000 shares instead of 3,000 shares. And I'm like actually the example that comes to mind, this is actually, I think, a staff engineer or something like that. This was Instacart versus Pinterest. And Instacart was at like $75 a share at the time, and Pinterest was at 7. And I think he got like 2,000 shares from Instacart and like 30,000 shares from Pinterest. And like he thought those were like wildly, like he thought like, oh, how could that be? And just never really occurred that that's the case. And obviously this gets even more complicated when you have splits and adjustments and things like that.
Well, I think there's like, even in the case that you've mentioned, like, because shares are not like, it's not apples to apples. It's like a unit that's not really comparable across companies. So a share of Pinterest at $7 could actually be a far better deal, because you think that the upside is far greater in the long term versus whatever Lyft or Uber or other companies are at. It's interesting. Is like we actually see executive recruiters even get this wrong. Like I was talking to an executive recruiter that was like very fixed on the number of shares they would have rather than thinking about percentage wise, what is it that you own. I saw that Arca had a question in the chat, is like, why is it that founders are always hesitant to share outstanding shares? The sense that we get is like some founders may be hesitant to share the outstanding number of shares is A, like lack of knowledge on what this actually could be. B, it's they may not. Our view is like greater transparency is actually more useful for everyone. When you're joining a startup that early, like you're really betting on kind of the founders, the founding team, and everyone else at the company. Like you're one of 10 people. It's all hands on deck. The more information that people have, I think the more that we feel like they have as owners. But I think not every company shares that philosophy, and it's an information asymmetry. It's the case that if folks don't ask for it, you also don't get access to this information and negotiate, like miss out on a huge piece of kind of your compensation too.
Yeah, and I think unless that transparency is there, you're just going to write off the number of shares and say like, I'm going to treat it as 0 because I don't know what it means, right? And I think this is kind of what you're getting at, where it's like, you know, if you take a people-centric approach, right, and you actually think of this, it could be a potential differentiator for you to actually explain it well and actually help people understand what the shares could be worth. And yeah, so that was totally agree with you on that. But that actually is a great segue to sorry, I wanted to share one other story that like happened to us. And again, like I think of myself as somebody who's like lives and breathes equity, right? Like it's one of the most important, like it's a topic I'm like deeply passionate about. But like I did not realize the interaction that would happen between pre-money safes and post-money safes. So we had both. And the funny part is pre-money safe investors get diluted by post-money safe investors. And so until I actually just did a modeling exercise, I wasn't aware of that. And so I think even people who think like, it's like a little knowledge is a dangerous thing. Like it's actually really powerful when, you know, there's a tool that you have to use that actually can just like do it for you rather than you thinking like, oh, I can do this in Excel, right? But to just move to shift a little bit to something earlier you said around like, you know, offer letters and being able to explain things better. So how does that interact with, so the moment
Yeah.
you say offer letters, you now intersect with, like, you know, the things that DocuSign or Gusto or Rippling do,
Yeah,
right?
yeah.
The moment you talk about explaining offers, you're intersecting with Pave, right? So I'm curious how you think about like the ecosystem of other providers out there, and which ones do you think are better served on Pulley? Which ones do you think like are integration opportunities? I'm curious how you think about all those things.
We very much like to think that we can build everything for a startup. So we want to focus on building an amazing cap table experience and want to integrate with all the other providers that we can, so we can give a holistic experience to our users. So the reason I kind of mentioned offer letters is because if you really think about it, the equity experience comes actually even before the offer letter. Like when you're thinking about making an offer to someone that's joining the team, you're thinking like, great, if I give them X number of shares, like how does this compare to what the market is expecting? So like, how much do I have left in my option pool? All of that. The same as when you're fundraising, like before you actually add something to your cap table, like adding something to your cap table is the last step in the process. The first step is like, who do I want to raise from? How much money do I want to raise? How much dilution does this mean? All of that planning. For Pulley, it's like for us to really, I think, serve our users well, it's how can we start from the beginning, which is you're thinking about giving equity to somebody. You need to find out what do you need. And that's for us to partner with folks like with Pave and other compensation tools. We tell folks you can go to Option Impact, which has a host of data as well, to like, great, you're about to give the offer letter to someone that you want to join the team. How do you explain now how much these options could be worth? Because we know today the market is so hot that if you're going to Google, Facebook, the cash comp you're getting like on year one is tremendous. It's insane. Yep. So the only way for people to bet on the startups and the launch shots is if you can help someone understand how this could actually be the next Facebook, and you want to be an employee 10 at the next Facebook. So once they receive that option letter, then it's like, great, let's go and get all the paperwork done and then figure out how your cap table changes.
Yeah, that's funny. It just reminded me of an exchange with a friend of mine who, like, I was trying to get him to potentially consider joining us and so on. And he was like, I really want to start something because, like, you know, blah, blah, blah. And I was like, look, starting something is great. And I believe in you. I'm sure you'll succeed. But you know what's just as cool is like being one of the first 10 employees at Stripe, or one of the first 20 employees at Stripe, right? And I think, and he was like, you really think you're shooting for something that large? And I was like, why else would I be working on this, right? Like, to me, it was like an obvious thing. But I think that, like, I totally agree with you that, like, the process of, like, the process that, like, that was about cap tables. We weren't talking about cap tables, but we were talking about cap tables, right? Yeah. And I think, like, thinking about it in that, like, entire life cycle in terms of, like, how do you position the value of the company and the equity of the company is I think essential and like really powerful in terms of that experience. But so you mentioned integration. So maybe that's a good place to talk about, like, so when you guys think about your product roadmap, when you think about your, like, prioritization of various things to build, what are the things that you've prioritized and you will prioritize that aren't being done by the Cartas and the Captivos of the world, the Captivos?
So it's always like, I think, like, who you go for determines your product roadmap. And a great analogy I've often shared is like Amazon versus eBay. 2005, I think what's shocking to most people when we look at Amazon versus eBay now is that they had the same market cap. If not, like, eBay actually had a higher market cap. And Amazon was really scared of eBay because you're looking at Amazon, which is a really capital intensive business, and eBay, which is really low cost. Every seller is taking care of their own business. But what eBay has always done, I think, from the beginning, in some ways to their detriment, is they focus on the sellers as kind of your user. Mm-hmm. And what this means is they build tools for, like, inventory management. Amazon, I think, from the very beginning has always said that their user is the customer. So what that means is they prioritize features like, here's better search, here's Amazon Prime, how do we ship products to you even faster? And I think if you pick the right user, in the long term, you win. So this is how I say, like, we're not building Pulley for experts in cap table management. Not just for not just for the lawyers, not just for the paralegals. We want to make sure this is an amazing experience for you as well. But we're building for people that actually hold the equity. So what this means in terms of, like, the product prioritization is, how do we explain how options work for someone? That's not actually a question for managing your cap table. But the reason you give equity to somebody and the reason you need to manage a cap table is because you have employees with equity and you need to figure out how to explain it to them.
Yep. No, that makes perfect sense. Speaking of employees, so this, I think you and I had a chat about this the very first time we spoke, but having been an early employee in the past and always feeling like it's very opaque and it's often risk reward, not really a fair deal, right? I'm curious what you're seeing in terms of like both, I guess, philosophically, how do you think about it and how you treat it now as like, founder running a company with a bunch of early employees, but also how do you see based on the data, right? Like how are these norms shifting? So I think it definitely was the case that like 10, 20 years ago, like there was this like very big chasm. And I think that's starting to shrink a little bit. We've heard Gary Tan talk about like, for example, first employee should get 10%, right? That is like hugely different from like the way it was like, oh, first employee gets 1% and then goes down to like 0.5 and 0.25 and stuff like that from there. So curious what you're seeing and how you think about it.
So I know that like, because Sam Altman has like what is it, like 10% for the first 10. And I think this is a case in which like generic advice is like really hard to apply. It could be the case that you're a medical device company, in which case norms are just completely different. Maybe it's not 10% for the first 10, but like you need to close a few key hires and they need to get like 5-10% of your company each. Exactly. So I think it really depends on kind of the business that you're running and the industry that you're also in. For us, it's the case that, so I shared that like this tweet for like, we see so many cap tables. What is it that kind of repeat founders get right? I think one of the things that repeat founders get right is that they're generous with equity. What we mentioned earlier is like the BATNA for really good people is that they can go to Facebook, Google and make 500K cash comp. So if you're looking at this, it's like, well, what can you provide? Well, you can give them a chance to own a small piece of something that grows. And then the second point I would also add is like our philosophy is that you have to find people that want to focus on growing the pie. If you're looking for folks, it's like, I want like 1% or like 1.5% or and really negotiate kind of the details there. In some ways, like your equity is either going to be worth a lot or nothing at all. I think like for a lot of startups, it's not really binary. Like if you get the next Facebook, like you're either going to have tremendous success because you were one of the early folks, or it really doesn't matter. So I think in many ways, like if you're both able to be generous with equity and also focus on growing the pie, and you can find people that share that mindset, then that's solid for kind of a founding team that you want to bring on board.
Yep, totally agree with that. And so we're actually working on and should have out in the next couple of days just like a friendly free tool to help like estimate like, oh, what your fully loaded compensation should be. And honestly, that's like, I suppose it has association with some of the things we're doing at AbstractOps, but I worked on that as like a side project just because I thought it's something that should exist in the world, right? And so the issue with Option Impact and some of the others is that they're phenomenal for late stage. They're garbage for seed stage, right? And so we actually tried to reason out from first principles, what should some of those benchmarks be based on the profile of the person and so on and so forth. So I'm really hoping that we can help move the chain a little bit, the goalpost a little bit.
Well, so one of the questions that we often see is also international equity. And I think this is where you often get even more confusion from folks internationally, because I think equity can feel like it's a lottery ticket. Like if you've been at a company that's done really well and your equity is worth a lot, then you're like, I want as much equity as possible in my next round. But internationally, we've seen like, I think some of these big ticket wins haven't actually played out as much. So people do negotiate for more cash comp, which is fine. So what we do at Pulley is that we also give people a choice. Like we do the like, here's a high equity comp, here's a high cash comp. You can kind of choose which one also fits better for your lifestyle and your risk profile too.
Absolutely. And it is an extremely tricky thing to provide that trade-off without saying that your common shares are being traded off at this dollar value, because that has implications on your 409A as well. That's a fine line to toe.
Yeah, exactly. I think in some ways, like for a startup, it's a case that we try to be really transparent on how risky it is when you're joining a startup. Like we ask people like, hey, like if you believe there's going to be more startups created in the future than that there exists today, then Pulley is a great bet for you. Like if you should rationally only join us if you think we have
picks and shovels
where we are. Yeah, exactly. Picks and shovels. You should only rationally join us if you think we have more than 1,000x left. Because otherwise, I do think in terms of cash comp, you can find a better opportunity elsewhere too.
Of course. Totally. So Temina had a question on if you want to take a look at that and had any thoughts on that.
Oh, cool. So Temina had a question on like, curious if you've connected with Founders Pledge or provide other options for founders who want to set aside an amount for charity. This is the first I've heard about them. It sounds like a really interesting piece. So like from the beginning to be able to kind of set aside a portion of your shares for the greater good too.
If I remember correctly, I think this is, so I think this is for us as like founders or executives to like set it aside rather than the company setting aside something. This actually does ring a bell because I think I have a couple of friends who are early employees at Uber and stuff like that that actually did take it, because, you know, again, to the earlier point, if you're one of the first 50 employees at Uber, like it's better than most founding journeys.
It's definitely better than most founding journeys. I feel like what you have to do is just make this this is my first time heard of it, and so I'll check out the website. I feel like you have to make this as easy as possible for someone to click a button if they want to opt in, because like the first thought I have is like, I don't even know what that looks like practically for me to go and do that. Like if it means that like with the 1,000 things that most founders have on the list, I think we can get more people to opt in if it's just really the click of a button too.
Totally, and I think I think at least in part, it's obviously it's a pledge because it's illiquid. You can't do anything with it now anyway. But I have to imagine it's something along the lines of yeah, like it's an opt-in. You sign a document, you come onto this, and then basically you probably donate to a donor advised fund or something like that down the road when it's either public or liquid or close to.
Yeah, that's cool.
Cool. Great. Let's switch gears a bit. Let me pull up the question list here. Sorry, I accidentally closed it from earlier. So maybe I'll actually pull it up in parallel while I'll ask you a question in the meantime, just off the top of my head. What do you think about valuations in the market today?
They're crazy. Because I mean, you used to have standards where it's like SaaS companies, what do you get, like 30x multiple? That's considered if you're doing really well. I think all of that has been thrown out the window, and it's in a very quick time. Really, I think last year, because the window that we saw was like COVID, everything dipped.
Yeah.
Funding pause, like the stock market crashed by 20-30%. People weren't sure what's going to happen. I was actually in YC when that happened, and like anecdotally, people were saying like, oh man, this is a pandemic bunch, because you don't know what's going to happen with funding. But then after that, it's like it's more than picked up, because what you saw was this huge surge of, well, people don't need this, people are still buying things. It's more like all of this behavior has shifted online. So e-commerce companies have done really well, like valuations have gone through the roof. I think I kind of go back to fundamentals, and this is where I think understanding of equity also plays in. I think for most companies, they can likely go and find easy money. But the thing that we actually try to remind founders is that funding is not free. Like if you're taking funding, it is dilution. If you're taking funding, look at the terms. Oftentimes, it can also restrict your options in the future. Like if you raise at X million valuation, that means realistically you cannot sell for less than a multiple of that. Like figure out like what do you want your exit plan to be, and also consider that too.
Totally, and I think besides the exit plan too, it's also the clock's always ticking. The more institutional capital you take, like if you take 10 million at 50, it means you're promising that next year you'll raise it at least 100 pre-money, right? Like that's more or less the benchmark that you're setting, because the best companies at least double year on year, if not more, right? And so basically, I think it's the way we're thinking about our next raise, for example, is like, what are the numbers we know we can nail by the end of 2022? And then what valuation do we think that will justify at that point in time? And then chop that by a third, right?
Yeah.
And then like that's the valuation we think is like reasonable for us to be okay with, even if we could theoretically get more, because we don't want to price it to perfection and risk a down round, obviously.
Yeah, and I think the other question I would also have is like, what do you want to use that money for? Because like, what's the rule where it's like the task takes as much time as you allocate to it? I think the money rule also applies here, where you're going to spend as much money as you have access to capital. So like, what do you actually want to use the money for? If it's the case that companies have figured out what their go-to-market is, what their marketing strategy is, what their sales strategy is, and they just need to throw money at the problem, hire people, and accelerate marketing, fantastic, go and raise more. But then we've obviously kind of seen examples when it comes to WeWork and other companies have done down rounds and significant down rounds where it doesn't really always pan out. So I think we kind of like go back to the fundamentals, which is like, what do you think you're going to use the funding for? How is the business doing today to this, and what does your runway look like to decide like, should you raise or should you pause?
Yep. No, totally spot on. And I think I feel like this is one of those things where every time someone says, oh, college is completely useless, just go like start a company, I'm like, yeah, but maybe people should understand an intro to economics and intro to accounting class, right? It's probably like not the worst thing in the world to understand how, demand supply dynamics work, how, like how, performance, what gross margin means, right? Like, and contribution margin means and stuff like that. So I do think I do. So I guess this is my somewhat minority opinion. I think, yes, we should make it for anyone to start a company, but not one, because I think on the flip side, my humble opinion is that I think there are too many people who have no business starting a company, right? Because it's the sexy thing to do, because it's like the cool thing to do, and so on.
Yeah.
I think it basically, like, I think we share the mission of, if you are destined to be one, so to speak. And sorry to sound all grandiose about this, but if you're destined to be a founder, if you want to start a company and run a company, and you have deep conviction, deep topic matter expertise, deep relationships to be able to make that happen, then how do we remove all the annoying little inconveniences that waylay you along that path to finding product market fit? And, capital management, operations, all of these things are like huge elements of de-risking that.
Yeah, because like you mentioned picks and shovels earlier, and what we also say at Pulley is like we like to build the plumbing for this. And I think the part that maybe some folks miss is like plumbing is dirty work. It's not like, a lot of times like what you're literally doing is like a lot of grunt work, more or less, to speak. It's not super glamorous. Because when I look at candidates' resumes and they only worked at a FANG company and they're coming to Pulley, it's like, great, like let's talk about what it actually means to work at a startup, because there's a TechCrunch version, and there's like, let's peek behind the scenes of like how you're going to be working like twice as hard for probably less immediate capital. Like what we get upside is like, you also get far more ownership in your work. You can have a far more accelerated career path, but again, kind of not for everyone too.
Yeah, totally. It's I think a way to describe the environment at a 10, 20, 30% early stage companies, like barely constrained chaos, right? Like chaos is like just the norm. You just have to basically always identify the ways in which it's breaking that are riskiest and most problematic, and just de-risk those one by one.
Yeah, exactly. And I think that, like, to me, it's like that's one of the most exciting parts, because you get extreme ownership in the work that you do. There's no sense of clocking it in at work. When you're a 10-person team, you can kind of look around and see like, what is everyone working on, and you know what it is. And you know that these are the folks that you're in the trenches. Like, I love my experience after we sold my last startup to Microsoft and working there, but it's the case that I know that Office is going to pay the bills whether I show up or not. And at a startup, it's not quite the same. And I think like we have one shot, so might as well make it worthwhile too.
Yeah, it's that I do struggle with that a little bit though, because I mean, yes, you need that fire in your belly to like go execute. But on the flip side, anxiety isn't really like a health-inducing like mental state. How do you balance those two? Because I mean, I think desperate people make the best early startup employees and best founders, right? But like desperation's like not a good place to be. So how do you balance those?
Yeah, it's because I never like to think like you're running away from something. It's like it should be an opportunity you want to be excited that you're running towards. So when I think about like almost like the negative choices I've made historically, it's been when I've made a decision because I just wanted to get rid of like whatever I was doing now, and you were more like saying like, I hate my current situation, like let me go in and just do something else. And the times in which I've made a positive shift would be like, I'm really excited about this. Like I want to go and take a shot at it. There's this like great quote I've heard, which is everyone often talks about like, what would you do? What would you do like if you knew that you would be successful? In which case, like I think that's actually a really easy answer to respond to, which is like, yeah, sure, I'll make Instagram, I'll make Facebook if I know I'm going to be successful. These are all easy things. I think the question you should actually ask if you want to be a founder is like, what is it that you think is worth doing, even if you know you're going to fail? Where you think like this is enough of a mission that it's worth taking a shot on.
Yeah, no, that's awesome. It becomes a labor of love, not one of fear.
Yeah, exactly.
Awesome. So I was gonna switch back to like hardcore cap table stuff.
Yeah.
So in your views, like what are 3 of the things that like like even super tactical things, right? Like
I'll talk about
people
tactically.
tend not to know. Yeah.
So
what should founders know? What should early employees know?
Okay, so what I would say with founders would know is, especially if you're raising the seed round, understand what pro rata is. Pro rata means that investors have the right to invest in your future rounds and maintain their ownership percentage by putting in more funding. The way that investors I've often seen pitch pro rata is that means when you raise your next round, 10% is already taken because I will put money in. I think the founder perspective, the way that tactically should look at pro rata is like, I've actually seen a lot of founders have a difficult time raising in the next round because of pro rata. The reason is because like you want to align, because there's different stage of investors in the same way there's different stage of employees for the company that you're at. What you want to align is incentives. You want the investors that were like really helping you to have a shot to put in more money in the future. But if you have pro rata, that means everyone is like already has a guaranteed ticket in the door. So if you can, we always say like, try to remove the rights of prorata for your investors, like tactically. The other thing I would say is like a common piece of advice that we've heard is that you should always set aside just 10% of your shares in employee option pool. We talked a bit about this before, but like whether it's 10% or 5% or 15% or 20% really depends on your industry. Work backwards, figure out how many people do you need to hire in order to hit your next round. Because the thing that I think actually people miss is that you actually get diluted a bit if you have unused shares in your option pool. So if you only needed 7 to hit your next round, but you set aside 10, you, the founder, are taking the dilution. So actually figure out how much do you need, and we have tooling on Pulley that can help you understand that. And I think the other is like, keep it simple. There's no need for like really complex cap tables. We've seen some like vesting schedules that are like 1.28% vest like every month. Sometimes the standards are there for also a reason. Yeah, exactly. It's like for your vest, 1 year cliff, like some of the standards are useful. And it's like, this isn't, whether you optimize your equity in some ways or not does not make or break. Like focus on finding product market fit. Take the convention and just get the cap table in place and understand your cap table enough so you can make decisions on it, but don't spend all your time optimizing it. So that's what we would say, like oftentimes for tactical advice to founders. When it comes to advice for employees, I would say is like, yeah, understand what your ownership percentage means. And I think that's often important because like, again, like just getting the number of shares that you have doesn't give you understanding of the whole company's kind of life cycle too.
Mm-hmm. Makes a ton of sense. I was going to add one other thing around just the applications in vesting schedule and so on and so forth. So we actually have a pretty, we did innovate on that dimension a little bit, but we actually did it in a way that isn't like clumsy, right? Or at least tried not to be. So instead of saying, oh, it's going to be like this like weird non-standard vesting schedule for founders and early employees and stuff like that, what we actually did was just to take standard vesting schedules and then stack them one on top of another, right? So in other words, like the founders vest over 6 years, but it's not like 6-year vest, right?
Yeah.
It is, there's one 4-year grant, a second 4-year grant starting in year 2, a third 4-year grant starting in year 3. Math is super easy, right? It's just like three grants, right? But like essentially what that means is I'm incentivized to be here for 6 years and beyond, right?
Mm-hmm.
And most importantly, the other thing that this solved for is the fact that like if there's a founder breakup, right, you don't have this weird situation where there's a bunch of debt equity, which is always a huge risk because you know, things happen, right? Like people, you know, grow apart, right? And we've seen this instance with a bunch of companies where, you know, let's say it's 3 founders at 30% each or something like that. One of them stays 2 years and then leaves and has 15% of the cap table, right? And that is a big no-no when it comes to like future financings. And so you go into this like long drawn out negotiation over like, oh, I'll buy back 7% of your shares for like 10 cents on the dollar, blah, 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 all these other things. When really like this was a way for us to say, okay, cool, let's just like bake that. Like there's an implicit social contract amongst founders that we're signing up for this for the next like 10 years. So let's just like have it be longer, but not doing it in a very, let's say, clumsy way that like makes auditing later like difficult. So we did this kind of three grants for founders and 2 grants for founding team, basically. So anyone with over 1% gets 2 grants. Anyone with over 10% gets 3 grants, basically.
You know, I think that's also interesting because it makes me think of like actually another point, which is like oftentimes you often really have to trust the founding team because common liquidity event, sometimes cap tables can also get thrown out the window. There's a great book about Instagram that talks about this. I think most people don't know that early employees at Instagram didn't get any equity. They got equity, but they hadn't vested yet, because it hasn't hit the 1 year mark.
Got it.
So if it hasn't been 1 year, then if there's an acquisition event, in their terms, they didn't get any acceleration. So they're fine because they joined Facebook early, but they could have been much more fine than what they were. We've also seen cases where like, say the company has raised like 600 million valuation, but gets sold for 200, and yet everyone's option still comes out whole. Well, that's because the founder really fought for that to happen. So common liquidity, then it's like, you actually really have to trust the people you're deciding to stay with, because like a cap table is set in stone, but it's also not. Like it often depends on like, great, if things are going well, everyone's going to do well, but it's more like in kind of these outlier cases. You want to make sure you're done.
That's I think the word you're using there, the operating word, which I think is totally spot on. It's like trust. It's like equity is like literally a way of putting down on a piece of paper like trust, right? It's
Yeah.
basically saying, I will do this for you and you will do this thing for me in the future. And like I get to like we're encoding fairness and trust. What I was gonna say is yeah, like on the flip side too, right? Like a lot of other things, right? Like secondary transactions, right? Like obviously have
Yeah.
a ton of background in that. And I've seen like so much unfairness like play out in that kind of dimension. And like it's just, I mean, it's, do you trust the people that you're like jumping off a cliff with, right? Like that basically is what it comes down to. And I think that's the only litmus test worth doing, because like then negotiating for terms in a legal contract, yeah, to your point, like a lot of that stuff just gets thrown out the window when like when push comes to shove. And even the pro rata point that you make, right? Like when we were asked for pro rata as part of our like earliest round, I was like, look, we all know that it's a matter of relationship anyway. Like you guys have been the early supporter. I'm going to look out for you, assuming you're not like a jerk to me or anything like that. Like I will make sure that you get an allocation, and I've like kept that promise, right? But like putting it down on a piece of paper, like we also know that in an extremely hot round, like or with like a lead investor with sharp elbows, they'll be like, I'm not going to lead this round unless I get to take the whole round, and your pro rata investors can go to hell. What happens? Pro rata gets thrown out the window, right? So again, like I think encoding these things not in legal agreements but in social contracts are like a much better way of going about things.
Yeah, and it's I think that's the kind of the I mean that's kind of the fun part about doing the startup is you're figuring all of this out as you go, and it's like from the inside, it's there's so much I feel like I'm still learning day to day to figure out how to run Pulley too. Yeah,
no, totally. It's like a creative exercise. It's like shaping pottery.
Yeah, it's like every time you level up, it's like, okay, great. The next level now gets harder too. So let's figure out how to beat that.
Doesn't get it easy. And there was this fun quote from Michael Seibel at a South Park Commons chat that he held. Like, pardon my French, but I'm roughly quoting him. He's like, I think the question was something along the lines of like, what surprises founders, or like what should you tell people who are like first-time founders or whatever. He's like, don't ever expect to feel good. It's just like feeling bad, right? Like at the beginning you feel bad because you don't have product market fit. And then one of the most common side effects of product market fit is everything breaks. So then you feel bad because everything is breaking, right? And he's like, honestly, there's something kind of fucked up in all your heads that you're deciding to like embark on this kind of journey of of signing up to this kind of like years and years of like just feeling bad. But again, I think that's where your earlier point on the labor of love comes in. It's like that all gets like it's all worth it at the end of the day, because like you're building something like incredible. So
totally, because startups are hard when it's going well. Startups are hard when it's not going well. If it's going well, as you mentioned, everything is breaking. If it's not going well, it's how do you get it to go well? So you always have a problem no matter what.
Yep. Awesome. And then let's see, a couple other questions. So yeah, what's the party line and the real answer to, do I need to keep my cap table up to date? Because I will say this, except for during fundraising rounds, I've never seen a cap table that's up to date. So I'm curious, like how you think about the implications of that, and like what founders should do, what lawyers should do. How do you involve the different people to like what's your belief there and stance there?
Yeah, our take is like we think it's, so there's a couple of things there. So there's the cap table like that's up to date with like, here's all the investors I have, here's all employees that have equity. We do think it's actually like pretty important for you to keep that up to date, so that you actually have an understanding of how much equity do you have left to give out in the pool. Think about this as like planning for your hiring plan, or planning for your run rate. Like whether you have 5% equity left or 10 is actually a tangible difference for like who are the folks that you can bring onto the team. And you should know that. And it's hard to do that before your cap table is actually up to date. What we see it as a problem is that for a lot of the tools on the market, it makes it hard for you to keep it up to date because they're just so difficult to use. So with Pulley, we actually see it as kind of, that's our problem to solve. How is that we can make it easier so anyone can more easily keep their cap table up to date too.
I totally agree with that, and philosophically, I think we're totally aligned. The one thing I do worry about a little bit is, again, we just talked about how people want to know the bare minimum necessary to like not mess it up, right? And of course, you can always make it less and less likely they'll mess it up, but user error will always exist, right? So then, I have a little bit of fear over somebody who like doesn't really understand equity inside and out, like going in and entering like records that lawyers going to have to write a legal opinion saying this is like valid and up to date during the next financing, and it could result in all kinds of like things that blow up because it was entered wrong and so on and so forth. So how do you deal with that kind of like, I guess, avoidance of user error Because I agree with you. I just don't know what the perfect solution is for something like that.
Well, I kind of wonder because we've like when you say like up to date, like the way that we almost think about this is like there's folks that keep their cap table up to date on a spreadsheet and are just organized on making sure that everything is tracked, like X person. So I guess the question I would actually punt back is like if you're an employee at the company and you have X number of shares, I would hope that you would know that I would hope that the company that you're working at also understands that you have those shares.
Yep.
So for us, it's almost like a question of like, what does it mean to keep like your payroll up to date? That means everyone is getting paid correctly is like what it means to keep your payroll up to date. And I think that's the analogy when it comes to equity too. Like maybe this is not selling Pulley as much, but like if the easiest way for you to do that is like keep a spreadsheet because you're super early stage, go and do that. We think Pulley is a better tool for it, but if a spreadsheet is the easiest way for you to do that, fantastic. I think what's more important is that you do have a record somewhere. Because when you do go and do fundraising, that means investors are going to look at what does your cap table look like today, and you need to be able to have a good sense of here's what it looks like today, and here's our plans for the future too.
Yeah, totally. I could not agree more on the need to keep records and need to manage this stuff. That's like the stuff that comes back to bite you in a financing or an acquisition or whatever other event. I think the challenge is, again, the little knowledge is a dangerous thing piece, right? If it's in a spreadsheet, nobody thinks it's accurate, right? People are going to like verify, blah, blah, but there's something to go by. With a cap table, I think the implication is that, oh, it's in here, so it's accurate. So like, I think like this is I think a really, really hard product design problem, and I'm glad you're working on it because like I don't know how the hell to like even like start at that kind of on that kind of like dimension. It's like how do you tell people they've done it perfectly and correctly without a human looking over it and saying it's good, right? Like that, like an expert looking over it and saying it's good. So I'm
part of
curious.
It is like, so part of it is like we actually like it's a perfect way to kind of segue to almost like beginning the conversation. We talk about here's the entire life cycle. You need to give an offer letter to somebody. So it's not that you don't know that you've given 1,100 shares to Bob, but more like once you give them the offer letter, it's not recorded. So if we can help people take care of the entire life cycle, which is send an offer letter, record it on your cap table, then your cap table by default becomes and stays up to date. So if you're sending the safe directly through Pulley and have it be signed, and you can even track the execution of it because funding has been wired and we allow you to do that, then it's like, great, that can get automatically added to your cap table. So that's how we kind of think about it. It's like updating your cap table is almost like the very last step. And right now it feels like it's a chore. But if it's attached to kind of some of the more processes that you have already that you need to do in order to run your company, then it becomes far easier for you to keep your cap table up to date too.
And I'll say at the very least, one thing that we hope to help on is, those are for sure like things that are like as part of our systems, like end up in cap tables. But I mean, the same problem is something we see across, for example, the breakdown or the cracks between hiring and regulatory compliance, right? And that's another crack that needs to be solved, right? And between, for example, hiring into your financial model, right? How do you make sure that information is reflected and so on? So obviously the thing that we're trying to do is to essentially be the connective tissue, the data layer, so to speak.
Yeah.
So, I mean, one analogy we've thought about is like, it's like Segment, what Segment does for like passing your customer information, marketing information back and forth, and acting as a conduit for that, but instead like doing that for corporate data, right? So I think we've talked about us integrating soon enough, and I'll owe you an email on that in the next month or two, but I'm excited for the time when this stuff stays de facto up to date because it's all like unified, it's all automatic, and it just happens and it should feel like magic.
Absolutely, I think that'll be exciting.
Yeah, we're right at time. That was an accidental conclusion. You want to say any other questions from anyone, or Yin, are there any other things you wanted to add, or any closing thoughts?
I mean, this was a really fun conversation. If anyone wants to get a cap table, feel free to reach out. I'm yin@pulley.com, and you can also go check out our website. We help companies with cap table, with 498 valuations. One thing that we do think about for how Pulley is different from other products on the space is we say three things: speed, service, and it's also just really founder friendly. On the speed part is like we actually have a lawyer on our team that onboards every company or helps companies onboard if you're looking to get onboarded directly, so that we can make sure your cap table is good to go too.
That's amazing. We're gonna have to take you guys up more on that. And I was gonna say yes, big fan of Pulley, and I was gonna also add, Yin is one of those rare people who somehow is just like always on email, and like the response times are phenomenal. So if you reach out to her and try to get set up, you'll be in great hands.
Thanks, Hari.
Awesome, folks. Thanks for tuning in.
Awesome. Take care.
Thank you. It's awesome.